Uh, Hello, welcome back to the continuing lecture in investments. In our last lecture or last lecture video, um, we discussed, everything about convexity and how the implication of, convexity, um, or benefits of higher convexity, or the downside. Um, now, so we are now moving on to the active bond management. Now, it has to be active. You remember, using duration, we were able to immunize the bond portfolio. But again, immunization is not a perfect passive strategy because eventually you would have to adjust uh, uh, the weight, right? You would have to adjust the weights in our portfolio, rebalance, in other words, rebalance the portfolio every year, or as as the interest rate changes, right? Because as the interest rate changes, duration changes, and then portfolio may not be balanced uh, anymore. Uh, Immunized portfolio may not be immunized anymore. So uh, immunization is not a complete uh, passive strategy, right? It's also the same thing in uh, actually in disease. In case of trying to immunize against some vaccinate, right? By vaccination, trying to immunize against uh, some type of disease, right? I mean, the virus, if it is caused by virus, and we all know virus also mutate. Viruses mutate over time, and as virus mutates, then we would have to come up with new vaccine, and so it's like rebalancing, just taking uh, one vaccination, just taking one shot of vaccination. It may last for some time, but if as long as the virus doesn't mutate, it will keep you completely immunized for the rest of your life. But then since viruses also mutate, and then every time you'll have to. That's flu, basically. Flu. You take flu shot every year because every year we see new strand, virus strand, which is basically a result of mutation. So just like that, I mean, this analogy may be uh, kind of weird, but um, as the interest rate changes, right? Uh, it's like the duration also changes, right? So it's like mutating strands of new new strands of virus, so new strands of same virus. So you will have to get immunized over and over, which is rebalancing, right? So it's not a perfectly passive strategy. So active management, uh, bond portfolio management is inevitable. Now, let's think about the two sources of potential profit. Well, two sources are interest rates forecasting, anticipating movements across the fixed income market. If declines are forecast or forecasted, right? Forecasted. Uh, this is a little, controversial. I mean, I'm talking about the grammar part, because forecast, when I was when I was a teenager, there were forecast was a irregular verb, meaning, past, and the past participle of the verb forecast was still forecast. This forecast is in present tense, past tense also forecast, and then past participle was also forecast. But nowadays, people somehow, I hear also forecasted, right? Past tense is forecasted, past participle also forecasted. But anyway, if declines in interest rates are forecasted, that will increase the portfolio duration, right? That will cause, and if increase is forecasted, increase in interest rates are forecasted, or uh, increase seems likely, it will shorten portfolio duration. Anyway, think about it, because it is, discounting, right? I mean, interest rate change is built into the duration, right? Because duration is, basically the sensitivity, change in bond price over change in Y, right? And as, interest rate change, increases, right? Duration will go down, decline. Interest rate change declines, right? Increases portfolio duration. Now, identification of mispricing in the fixed income market. I mean, mispricing is a source of your profit, right? So these are, think about it. And I've been telling you over and over from Finance 100. Long run, there are only two ways you can make money in. There's only one way you can make money in the market. Buy low, sell high. Buy low, sell high. That goes without saying. Of course, including short selling. There are two ways. You sell high and buy back low, right? But normally, the ideal situation is you buy low and sell high. Short selling is very risky, and generally you should never, short sell, because there's no guarantee that what the scenario that you are betting on, that scenario, there's a very low chance that you nail it, right? Exactly, you nail it. But the point is, so you buy today, and this is called, buy and hold strategy. Buy and hold. You buy and hold it for long term, and as the market, as the market goes up, then you can sell it high, and that's source of profit. But then that's really the investment strategy, for long-term investors. But for short-term investors, the short-term investors do not have that patience. Short-term investors, like day traders, day traders just buy and sell and make those transactions so frequently, right? Multiple buy and sell transactions even during the day. That's why they're called day traders. Even if you're not a day trader, if you're a day trader during the same day, you have to spot that buy low, sell high moments, right? But even if you're not a short-term trader or day trader, You can still make money in the short run market, or it could be long run market as well. Identifying the mispriced asset, right? Mispriced, especially undervalued asset, right? And I've been talking about this over and over. Undervalued, always anything undervalued is a buy opportunity, right? So an analyst might believe that the default premium on one bond is unnecessarily large and the bond is underpriced. So default premium is what? In the what is default premium? Default premium is in the form of interest rate, isn't that right? Uh, Basically, uh, the structure of interest rate is uh, there is pure return, right? Pure return, which is also considered real return, usually about 2%, 2 to 3%. And then there is inflation adjustment. Inflation adjustment is the protection premium for inflation, which is across the entire economy. So every bond has inflation uh, premium. So let's say triple B bond has 3% pure return, and then which is real return, real rate of return, because it is net of any inflation adjustment, and then you add 2% inflation adjustment to that inflation premium. That will make it 5%. This is nominal return, nominal, right? Nominal or base rate. And then on top of that, inflation is across the board. Every think about it, because this macroeconomic is systemic, right? It's coming from the macroeconomic system. Every company is affected. Every bond is affected. Every bond has to have this inflation adjustment built into that. And then comes in the default risk premium. And default risk premium is firm specific, right? Depending on individual firm, right? Default risk would vary. So default risk premium is it depends on the risk class. And let's say for this company, which is already in triple B class, and let's say average of the triple B class, the risk premium, default risk premium for average triple B company is let's say 2%. Okay, then on top of 5% base rate, at 2%, that should be 7%. But this company, let's say, has 8%, 3% default risk premium. Then this is out of line with the average of for that triple B class. And then obviously, what's going to happen? The discount rate for this bond is unnecessarily 1% higher than average. Then discount rate is higher, so the valuation of the bond is lower, undervalued, right? Undervalued. So it will generate abnormal returns only if the analyst information or insight is superior to that of the market. And so if this is really undervalued, then you will it will give you, it's a source of, have to good return, better than average return, right? Also called superior return, better than average return, right? Now, uh, interest rate forecasting is also something that is very often used because we can always predict the interest rate movement rather in the in the on the long-term basis. We can forecast interest rate movements rather with certainty because there is always Federal Reserve, always Federal Reserve after each FOMC meeting, right? The Fed chair, Jerome Powell now, right? But previously, I remember, from Paul Volcker. Paul Volcker was, Fed chair in the late 70s and early 80s, and then it was, Alan Greenspan. Alan Greenspan from like late mid 1980s throughout entire 1990s and early 2000, even early 2000. And then it was Ban Bernanke, and Ban Bernanke was the Fed chair, through the financial crisis. And after Ban Bernanke, he served 2 terms, I believe. And then Janet Yellen, who served only 1 term, and then Jerome Powell. Currently, and Federal Reserve chairperson always holds press conference after the FOMC meeting, and they basically explain how Federal Reserve sees the economy, and so what kind of monetary policy Federal Reserve will pursue. So this is called guidance. So there are like 8 FOMC meetings each year. So there will be 8 press conferences and 8 guidances from time to time, right? And then you will, so that would be almost every 2 months, right? Every 1.5 months, right? And then from the guidance, you can tell whether the Federal Reserve will maintain the current level of interest rate, or raise interest rate, or lower the interest rate, right? So interest rate forecast is relatively reasonable and reasonably accurate, and it can be reasonably accurate, and we can form anticipation based on the Federal Reserve guidance, right? So then when interest rate is gonna when interest rate is expected to go down, of course the duration, that's going to increase the duration, but lower interest rate will push up, drive up the price value, right? So you make profit from higher valuation of your bond holdings. So anyway, so also remember this name, Homer and Lebowitz, and these guys were the one who proposed, the 6th rule, non-mal kill. That was non-mal kill number 6, right? Non-mal kill number 6, or non-mal. These are the and then their active bond portfolio strategy, portfolio management strategy is as follows. First of all, it's called substitution swap. Okay, swap. There are like credit default swap and interest rate swap, exchange rate swaps, and interest rate swap is I mean swaps are generally like a insurance policy, right? Especially credit default swap is what the insurance companies sell, and those who sell these swaps are the ones who are betting. Uh, let's say they are betting interest rate is not going to go up, right? That's why they can sell this swap. And if interest rate goes up suddenly, then then those who bought these credit default swaps, right? They will exercise their insurance policy, and then they get paid. Now, when interest rate suddenly goes up, think about it. The valuation of my bonds would go down, right? But if I had bought this, credit default swap, then I get the exercise value of my, the guaranteed value of my bond from the not from the company that sold the bond, but from this insurance company, right? And of course, then they will take the loss, right? So it's a game of probability, and they are betting that the chances of interest rate going up is less than chances of that going down. So, and if they think interest rate is going to go up, they won't sell. It's 100%, 100%, loss, right? The probability of loss is 100%. So they won't sell, right? Credit default swaps. But anyway, so substitution swap is exchange of one bond for bond, bond for bond with similar attributes, but more attractively priced. Okay. Yeah, same risk class, but one thing is more attractively priced. What does that mean? It's undervalued, right? So it is motivated by the belief that the market has temporarily mispriced two bonds. I mean, if they have same risk characteristics and many other, let's say, other, fundamentals, right? Other fundamentals, right? Then they must be priced the same, right? They have the same risk factor, all other same attributes, fundamentals, basically, price earnings ratio, price to book ratio, all these, ratio variables are pretty much the same, but one bond is particularly, undervalued than the other. Then, this is mispricing, spotting the mispricing in the market, right? With discrepancy representing, profit opportunity. An intermarket swap, exchange of two bonds from different sectors of the market. And this is based on the belief that yield spread between the two sectors is temporarily out of line. So if one, so this is, quite obvious. If one sector, one industry, right, and the other industry um, from other sector, right? Uh, Suppose their yield spread has certain, pattern. Of course, one industry and another industry, they they won't have this, same yield. Some industries are more, leveraged. Some industries are less leveraged, right? And the industries that are more leveraged, um, more highly leveraged, would have a different uh, lower yield than the one that has, lower leverage, right? That's uh, when a company, when an industry or a company is highly leveraged, right? The financial distress is higher. Financial distress means, uh, also default risk, right? Think about it. All the earnings are going out to pay for debt servicing. So the profit margin gets narrowed, right? So uh, so one industry and another industry would have a certain uh, yield spread pattern, right? But uh, temporarily, if this yield spread is misaligned, right, then uh, you would like to take advantage of the one with lower yield or higher yield, depending on your purpose. The one with lower yield would uh, lower than the average trend, right? Uh, and most likely the one with the lower than average yield would because it's lower discount rate, it will give you less discounting for valuation of your bond, right? Uh, Yield relationship only temporarily out of alignment until the aberration is eliminated. Gains can be realized on the underpriced bond uh, during a period of realignment. And as I said, also depending on what your what your purpose is, what your goal is, you want to find an underpriced asset, right? Uh, and the underpriced asset, uh, generally, is underpriced due to higher yield, right? So higher yield and the higher than average yield is, the result of misalignment. Okay, so that would be the reason for, and then you buy, always, underpriced asset is a buy opportunity, right? And the uh, overpriced asset is a target. I think somehow I made I should have, the bullet points. I think they should have been like this. And then, yeah, this makes more sense. And the underpriced bond, until this aberration is, eliminated, gains can be realized on the underpriced bond during a period of realignment. Realignment is called, also workout period. For example, um, uh, if the workout is the term that is usually used for a bond that has, a company that has, defaulted, or went into bankruptcy, but not necessarily. It's not necessarily that in that context. Still, because workout is a very general expression. The company is working out to, straighten out uh, this misalignment. In other words, their uh, yield is, unnecessarily high. Why? Well, because investors demand higher return. Why do the investors demand higher return? Their risk is perceived to be higher, right? So they couldn't sell the bonds, at the previous um, coupon rate, because they want more. They perceive more risk from this company with this company, so they demand more, higher coupon rate, because if the coupon rate is higher, and uh, for that reason, overall yield would go up, right? So as they, then during the workout period, they raise their credit rating, right? And that way, it is, realigned. And then, when they sell the bond, after uh, yield has, dropped, then the, selling price of the bond would be uh, much higher than when they bought it, when the yield was lower, when the yield was higher. So this is a source of, a potential source of profit. Okay. Now, so pretty much, we have, gone through some of the active management strategies. Other management strategies are uh, interest rate anticipation swap, right? So that's generally called interest rate swap, and the pure yield pickup swap, and tag swap. So there are many swap. Uh, there are many swap strategies. Uh, I guess we don't have time to go over all of it at this point, but we have basically covered the first three types of first two types of swaps, and then interest rate swap is pretty much uh, uh, explained already in passing. So, but anyway, we're gonna uh, discuss the remaining three types of swaps in the next video. Okay, so we are almost out of time. So let me stop recording and see you guys in the next video. Thank you for watching, and stop.